Hi guys, so this is Stephen from Chartered Tax Accountants, just in case you've never seen my face before, you've never spoken with me, but this video is mainly for clients, but it's also something we shared on our website just to explain to small business owners with their own limited company how a director's loan account works. So it is, our plan is to put together a lot of content to in terms of resources for people with small businesses, whether you're self-employed or you have a limited company. If you're a client of ours, it doesn't mean that you don't have the support of us personally, but it's just something that it's there and it's available in case you need to refer to it. So one of the most common topics is a director's loan account, because it's quite a strange concept if you're new to having a limited company. So I thought I'd cover it at an overview level without getting too lost in the detail, just to explain some of the principles, how it works. So I've got a spreadsheet open, and you might not be familiar with spreadsheets, and it's not going to be anything too complicated, but it does help me to explain the numbers with a director's loan account, because it's kind of like a set of weighing scales where you need to balance it off. So hopefully it makes sense when I show you the numbers and you can see it you can see it visually on my screen. So, okay, so if you bear with me, my typing is a bit slow. So we've got director's loan account here. So before I even start typing some content on the screen here, just change that. I'll quickly just cover the sort of things that we think about with a director's loan account. So the sort of things that is relevant when we think of director's loan account is wages. So if you're the director and you pay yourself a salary, that can have an impact on your director's loan account, and I'll show you the detail exactly how it impacts it in a minute. Dividends, if you take dividends from your limited company or you're due to take dividends, then that can have an impact. And also the other main area is any personal expenses you've paid for on behalf of the business. They need to be legitimate business expenses, but you've paid for them personally. So they're the three main things. And finally, I'm just going to give it kind of blanket general description, is what we sometimes refer to as drawings. But what we mean by drawings is really money you've taken out the bank. Because when you take money out the bank, you don't always know, when you've got a small limited company, is that a salary? Is that a dividend? Is that an expense? So what we often refer to as money out the bank is just drawings, and I'll explain that as well. So they're the main things, and we'll also briefly cover directors' loans as well. So let's start with what I refer to as drawings, and let's say money. No, so we're going to do it kind of from a technical perspective and also a practical perspective. But I'm going to start with technically what should happen when it comes to how you take money out of your business when you've got a small limited company. So when you take money out of the business, you can vote yourself a dividend. And for anyone who's wondering what a dividend is, it's basically profit from the business. So salary is not you taking profit out. In a practical sense, if you've got money in the bank, you've got money in the bank. I understand that, and you might have money in the bank. Let's say you've got £10,000 in the bank, but that doesn't mean that that's £10,000 in profit, because it might be that £10,000 is to pay the VAT man, is to pay the tax man, or is to pay a supplier because you owe them money. So that's not profit. Okay, so let's pretend out of that £10,000 in the bank, you owed out in total for your business, your tax, your VAT, whoever you're money to, you owed out £5,000. So what that means is you've basically got £5,000 left as profit you can take out. And that's what we talk about when we talk about a dividend. But often when you pay yourself, you don't always know exactly what your profit is. And that's where a director's loan account comes into play. Equally, you can pay yourself a salary. You might say, right, as a director, I'm entitled to £700 a month, or anywhere up to around just over £1,000 a month, depending on what's most tax efficient. That's the typical salary range we advise, and it depends on how many people are in the business. So anything between roughly £700 all the way up to £1,100. That is a salary typically. and anything above that is a dividend. So let's make sense of this in a very visual way. So you want to pay yourself a dividend because you know there's profit in the business, and let's say the dividends you want to pay yourself, and normally this is for a period, for a year. So let's say year ending 31st of March 2020. So you want to pay yourself, and there's enough profit in the business after your tax bill, after all the money you go out to do so. You want to pay yourself £20,000 in dividends. Well, let's make it a bit lower. Let's say £10,000. You want to pay yourself £10,000 in dividends. Just tidy this up. So that's, I'm going to put some notes on the right hand side here. And also we deal with debits and credits. Don't worry too much at the moment if this doesn't make sense. It will hopefully make a bit more sense in a second. So notes is profit from business. Well, it's not the whole profit, it's part of the profit. We say from profit from business. Okay, so dividends is from your profit in the business. There needs to be enough profit to do that. At this stage, you might not, bear with me, I'm just having a sip of my tea, if that's okay. At that stage, you might not have physically paid yourself that dividend. But what you've done is you've drawn up some paperwork to say you want to pay yourself a dividend. So technically, you're supposed to do a dividend voucher. We don't always see our clients drawing up dividend vouchers because they don't know when they pay themselves, is it dividend, is it salary? It is a service we can offer. We can do it on an annual basis, or we can do it as you're going along, so your paperwork tallies up with what you're paying from the bank. So that's kind of what crossing the T's, dotting the I's, having your dividend vouchers is what technically you're supposed to do from a legal perspective. But the point I'm trying to make is you've got the intention to take out £10,000. Whether you've done the paperwork or not, you should technically do the paperwork, but you've not physically paid it yet. Okay, and this could be two directors. This could be on the right hand side. We could have exactly the same for two directors, or even how many you've got, 3 shareholders in the business. So you want to pay yourself £10,000 worth of dividends. Okay, so on the credit side, it's owed to you. It's owed to the director. Owed to the director. Okay. Everything on this side is owed to the director. Let's just sort of shade this area in. Okay, I couldn't think of a more creative colour, so I've just gone with grey. Let's just put that in there. Okay, so if nothing happened at all in the business, apart from what you can see on the screen, so you've decided to pay yourself £10,000 because there's enough profit in the business, but you've not made that payment. You've physically not made that payment. You've just said that you owe yourself, you're going to declare £10,000 worth of dividends. Then at the end of the year, if we were to add up the 2 columns, they won't be in balance. You know, the credit side is £10,000 higher than the debit side. So because it's on this side of the, it's a credit, the business owes you that money. So the director is owed £10,000. Okay, they've not physically taken it from the bank. In addition, you might say, right, I'm going to pay myself a regular salary of £8,000 a year. Okay, so roughly £700 a month. That's a bit lower. It should be 8,400, but we'll do nice round numbers. So you want to pay yourself a salary because that's what's tax efficient. Yeah, so you want to pay yourself a salary. Okay, so in terms of the notes, and on the right hand side we do paperwork. So this is crossing the T's, dotting the I's when I mentioned the paperwork column. So technically, to pay yourself a salary, you should submit it through a PAYE scheme. You should have a PAYE scheme set up. You submit that salary on a monthly basis. We do that for the vast majority of our clients. We submit your salaries every month. So I'm just going to put a note there, submit to HMRC through a PAYE scheme. I don't want to go off too much exploring and explaining the different elements of a director's loan account, But the reason why you want a PAYE scheme set up is to take advantage of your tax-free allowances. So everybody can earn up to £12,500 completely tax-free, and also so you can get a national insurance credit for your record, so you get your stamp, which helps qualify towards your state pension when you're older. So that's one of the reasons, and also salary is an expense to the business. I'm not going to confuse things and go into too much detail, but the business gets tax relief on salary. So business gets tax relief. So it reduces the taxable profit. Dividends don't, because dividends come out of profit. Salary is an expense, okay? Think about it as if you're paying somebody else. It's not a shareholder, it's not a director. You're paying someone who works for you. That comes off the profit, and your own salary is exactly the same. If you're thinking to yourself, why can't I just pay myself a higher salary and I don't have to pay any tax? It's because if you pay yourself more than a certain amount, you're going to have to pay personal tax. So it basically cancels each other out. So the reason we do it up to 8,500 or 12.5 is it's most tax efficient. And we'll do a separate video to explain the difference between the salaries, why it's 8.5 and why it's 12.5 typically. But for the purpose of this, we're just going to look at the director's loan account. So you're entitled to, in a year, £10,000 of dividends, £8,000 of salary. I'm just going to elaborate on the salary for a second, because sometimes there might not actually be the money in the business to pay that salary. There can be instances where the money's physically not there. That does not mean that we don't process the salary. We still submit the salary, so we would still submit it to HMRC, £700 a month roughly. We'd still submit that salary to say this is the salary you're entitled to. But what it means is you're entitled to that salary, you've just not paid it, okay? So we never want to lose your entitlement, because your entitlement is all based around what's most tax efficient, not what money's in the bank, okay? So that's just a point to make, that when it comes to director salaries, it's not generally important what you physically have got to pay. It's more important what is the number we're going to submit to HMRC that's most tax efficient as possible. 99 times out of 100, if you don't have any other income sources, it's going to be up to 8,500 or it's going to be up to 12,500, depending on how many people are in the business. So you're owed £10,000 from your business, you're owed £8,000 from your business, okay? So let's say you physically pay yourself, and I'm going to call it drawings / money taken out. You physically paid yourself £12,000. Let's say, and it's just getting back to that point I made earlier, that when you pay yourself, you don't know what it is. You don't know if it's a salary, you don't know if it's a dividend. So let's say you pay yourself, for example, £1,000 per month. You pay yourself £1,000 per month. When you pay yourself, you know that we're submitting a salary for you, or your accountant, or you're submitting a salary, and you also know that you're taking some dividends, but you don't know exactly what the profit is. But to live as a director, and you're confident in the shareholder, the business can afford it, you decide to pay yourself £1,000 per month. So when we get to the end of the year, what we do is we look at both sides of your director's loan account. So we look at what you're owed, what you're entitled to in the business, and we also look at what you've physically taken out of the business. So in this case, you're owed £10,000 for your dividends because you've decided there was enough profit, I'm going to vote a dividend. You've also decided there's £8,000 salary. Well, you've not decided, you've been advised that that's the amount to run through your salary because it's tax efficient to do so. So you're owed £18,000, but you've only physically taken out 12, maybe because there's not enough money in the bank or you want to leave it in the business. So the balance remaining is £6,000. So at the end of the year, you're still owed £6,000, owed to the director. So if we were doing your accounts, and these were the real numbers in your business, in your account you'll have a balance of £6,000 owed to the director in your director's loan account. And the credit side, the money that you, is owed to you, to the director, is bigger. So you're owed £6,000 from the business. And that's the kind of basic principle with a director's loan account. Now let's also throw in some out-of-pocket expenses. So as I mentioned at the beginning, out-of-pocket expenses are genuine business expenses that you've paid for on behalf of the business. So if you were thinking of an employee for a large company, let's say there's 100 members of staff and one of the employees needs to travel to visit a client and they charge for using their own vehicle, their own car, and the miles they've done, it comes to, let's say, £20, then the business can pay them back that £20 tax free. And it's no different if it's your business, if you're a director, it's the same principle. If you paid for something for the business, on behalf of the business, but you've paid for it personally, the business can reimburse you tax free. Okay, so let's say travel expenses. You've got travel expenses for the whole year of £1,000. I'm obviously doing nice round numbers just to sort of illustrate the example. So what that means now is it's no longer £6,000 owed to you, you're owed £7,000 because you've not taken out an extra £1,000 to compensate for that. It's just as simple as what is owed to you, and that's everything on this side. So you're owed your dividends, you're owed your salary, and you're owed your travel expenses, and what have you actually taken out? If you wanted to get nitty gritty, you can try and break this £7,000 down. You could say, right, actually, although I've taken £12,000, 10 of that was paying, no, sorry, 8 of that was paying my salary in full. So let's have a go at that, okay? So let's do breakdown of director's loan account. So we've got £7,000. So let's pretend out of that £12,000, 8 of it was your salary. You've paid your salary in total. So you've paid your salary. So let's do due to director. Right, let's do salary. So due is £8,000. Paid is £8,000. Okay, because it's included in that £12,000. Just let's say for argument's sake, that's how you sort of do it as you're going along. It's included in that. So that means you've got an extra £4,000 on top of your salary, and let's pretend it's from your dividends. So let's do your dividends. We've got owed or due, to be consistent with the words. We've got due £10,000, paid £4,000. Okay, and then we've also got, finally, we've got your expenses, due and paid. So due £1,000, paid 0. Add this all up, we get back to £7,000. So what I've done there is I've just broken down why you're owed £7,000. But to be honest, it doesn't necessarily matter, because when a director in most small businesses takes this money out, they don't really label it as they go along, because this could be every week, it could be something every other day, it could be every month, it could be every 3 months. They're not normally, for a small business, it's not often that you're that disciplined that you can label exactly what you're paying. So what we tend to do is we look at it collectively. You're entitled to this, you're entitled to that, you're entitled to this. You've paid out this amount, here's the difference, you're still owed that for your director's loan account. And that is a director's loan account. So what that means is on your personal tax return, so apologies if I'm going into too much depth, but I want to be able to explain enough detail. It can get more complicated, but enough detail for to how sort of understand how a director's loan account works. So what that means is you're on your personal tax return, and please bear in mind that the company tax year might not be the same as the personal tax year. So your company year end might be August, it might be December, it might be whatever date it is, but the personal tax year is always the 5th of April or the end of March. So there could be a timing issue there. So let's ignore that for a second. But let's say on your tax return, what we do is we declare £10,000 as a dividend, £8,000 as a salary. So on your personal tax return, it would show you've earned £18,000, even though you've only taken out £12,000. So what that means is next year, the £7,000, you're entitled to take it from your business, completely tax-free because you've already accounted for it on your tax return, you've just not taken out the cash. I hope that is useful and that explains the principle. The one change I want to make to these numbers now is often there's a slight practical difference to this, and I wanted to show you this way of doing it because this is technically how it should work, okay? But for a small business, they don't usually know what their dividends are. They don't know what they're entitled to take because they don't know what the profit is because they don't have management accounts, okay? And management accounts is something we do for our own business, we do it for some clients, but we don't do it for a lot of clients. And the reason why we don't is because it does take a bit of work because you're producing a set of accounts probably every 3 months instead of every year. So for smaller businesses, the cost versus benefit is probably not worth it. That gets to a stage, and it's more important when there's more than one person in the business because you've got somebody else to hold you accountable when there's 2 people. When there's 2 of you in a business or 3 of you or there's multiple directors and shareholders, it's more important to know what the profit is in the business, in our opinion. So management accounts is a bit more important in that scenario. If it's one person or it's husband and wife, probably not as important because it's just you. So what happens is they don't know what the dividends are. So let's take away the dividends. Scrap that. Forget the dividends for a second. Let's take away that. So this is probably more akin to a normal, a practical example what happens with a lot of our clients. So we know you've got a salary of £8,000, and as I mentioned before, it doesn't matter what you've paid; it's what we've processed, and we always process what's best for you as a taxpayer, what's most tax efficient. So the salary is still £8,000. Your expenses are still £1,000 because your expenses are your expenses. The one point I would make of expenses is if it's just you in your business, if it's one person, you generally want to claim everything you can claim that you're entitled to because it's tax efficient. It's you are the business. If, however, there's more than one director in the business, if there's 3 people or multiple people, then you need to agree your expenses policy. What are you going to reimburse from the business? What are you claiming through your director's account? But that's not really a tax question. That's more of a business commercial decision as business owners. So you've got expenses of £1,000. You've got a salary of £8,000. Okay. You've taken out £12,000. So the difference is now £3,000. So exactly the same situation, but the difference here is rather than saying this is the dividends, these are the dividends I want to take out and declaring because I know what my profit is, it's being instigated from what have you physically taken out of your bank instead. So you've physically taken out £12,000. We know that £8,000 is a salary because it's been submitted to HMRC, regardless of as and when you pay that. So you've taken out an extra £4,000. However, you're entitled to £1,000 in expenses. So all in all, it's an extra £3,000 when you add up. Here's the weighing scales that I mentioned. This is where you balance the 2 sides. So what we would do in this situation is we would say balance, therefore, dividends. So as long as there's enough profit in the business, you could call it a dividend, okay? So what we would do is we'd balance it off and say, right, you've taken 12 out, we know that 8 was salary, 1 was expenses, so the rest has to be a dividend. So on your personal tax return in this example, you'd have £8,000 salary, £3,000 dividends, okay? Expenses won't go on your tax return because they're tax-free. Even though in this example, these numbers are still below the tax bracket, so technically they are tax-free, they go on your personal tax return. And let's just change these numbers. Let's make it £22,000. All we do is we change that to 13k. So whatever you take out the business, essentially, the salary it comes off of that, and then your expenses come off of that figure. What's left is a dividend. Essentially, that's the practical approach with a small business, limited company, director's loan account. You might have a situation where as we talked about before, where you've just taken less out. So let's just change these numbers again. I'm giving you lots of different situations. This one's the most common, the most the most practical way of handling a director's loan account. So let's say you've only taken out £5,000. So in this example, there's still a balance owed. So the balance owed is going to be £4,000 because you're entitled to 8 plus 1, which is 9. You've only taken out 5, so you're owed £4,000. So that is simply what a director's loan account is. It takes into account what you're entitled to, what have you paid. If you've paid above your salary, generally the balance is going to be a dividend. That's how it is. So finally, I want to talk about one other thing, and I want to talk about an actual overdrawn director's loan account balance. So that's when you've taken out more money and not declared it. I want to just give you an example of how that works. So let me just round these expenses off. Let's make it 10k. So we've got £2,000 of expenses. You've taken out £20,000. Okay. So what should be happening in a normal situation, which I've already explained with different numbers, is you've taken out 20, you're entitled to 10. So the £10,000 extra is a dividend. So we declare it as a dividend. We declare that as a dividend on your personal tax return. So on your personal tax return, you've got a salary of 8, you've got dividends of 10. Okay, so that's what normally happens. However, there might be a situation where when you don't want it to go on your tax return. Okay, I'm trying to think the best way to explain this. Either you don't want it to go on your tax return because it could be a tax credit, it could be whatever the reason is, you don't want to declare that on your tax return, or there's not actually enough money in your business to declare it as a profit. And I'll just elaborate on that for a second, because you've taken the money out of the bank, so how can there not be enough money in the business? I'll go back to my original example. If you've got £10,000 in the bank, it doesn't mean it's all profit, because you might still owe money out. In that £10,000, if you owe out 9, really you're only entitled to take £1,000 because 9 is not yours. So that's an example of where you can take out money that's not profit. So if a small business is taking out money that it should be used to pay the VAT, should be used to pay the tax, we can get into a situation where there's not enough money to declare it as a dividend because it's not come from profit. It's basically come from debt. It's come from money that should have been paid paying something else. So what we do in this situation is we've got an overdrawn director's account. So we've got overdrawn, and we can't declare it as a dividend because let's say there's not enough profit to declare as a dividend, and it doesn't go on your tax return. So you might be thinking this is too good to be true. I've had the money out, it doesn't go on my tax return, and on my tax return all I declare is £8,000 because there's no profit to declare it as a dividend. So the tax man knows this is too good to be true, and footballers used to actually abuse this a few years ago. So what you need to do is you actually need to pay tax on having an overdrawn loan account. And the tax you pay is 32.5%. So £3,250 would be the tax you pay by taking the extra money out that the business cannot afford to take out, okay, in this example. So generally, you want to declare it as a dividend if the business can afford to do so. Okay, it gets a bit more complicated. I'm not going to dive into the detail too much, but you actually get this tax back. This is called Schedule 455 tax. So if you have got a loan balance and you pay 32.5%, once you repay that money, and you can either repay this money by taking less out next year, keeping more of the profit in your business. That's one way of doing it. So let's say you've made £20,000 profit, but you've only paid 10. So you've basically left 10 in. That's one way. Or you can physically put the money into the business. You can transfer the money into the business. And if that happens, you do get your tax back. So it's kind of like a temporary tax. But what we find for a lot of businesses is sometimes they can't afford to put it back in. And this tax is held there for a long time. There can be some planning advantages in certain situations to take advantage of that. So hopefully I've gave you the whole scenario. There is a little bit more detail around this, so potentially you've got to pay a bit of interest and you've got to declare it as a taxable employment benefit by having a director's loan account. And there are some other details, but that is the gist of how a director's loan account works. Hope you found it useful. Any questions, give anyone at Chatterton Tax Accountants, myself, Richard, Simon, Lindsay, whoever you usually deal with, a shout, and we'd be more than happy to help you. Thanks. Cheers.